Hey y'all, today we're going to be responding to a Dave Ramsey's clip. Let's get into it.
Basically, if you bought a $500,000 policy, $300,000 policy, whole life insurance is 20 times more expensive, meaning it would be $100 a month. If you paid $5 a month, you get the same amount of term insurance.
That is a true statement. We love term because term is cheap and it gets us that death benefit. However, term is renting the coverage. We got to understand that. At some point in the future, the term is going to expire out after 10 years, 15, 20, 30 years, whatever your term is, then it's just going to cancel out. It's the same way with you renting a house versus buying a house. Why do you buy a house? Because it's more expensive. Well, you do that because you want the ownership, the appreciating asset of what a house is, the equity that you can tap into, true wealth building. It's the same thing when whole life versus term life is brought up in a conversation. And there's no one specific product out there for everybody. Everyone's got different goals. Everybody's at a different point in their financial life. And because of that, that's why some tools are used better right now for some scenarios versus others. Let's continue on.
The extra $95 that you are paying for cash value insurance, whole life, universal life, variable life, goes into a savings program that's called cash value buildup. And so you've got a savings account built into your life insurance purchase. That concept in and of itself is not bad until you learn the rules of the savings account. First rule is that the first 3 years that you own a whole life policy, 100% of your investment purchase goes to commissions.
If your policy is built with 100% base premium, that is a true statement, Dave Ramsey. However, when you are structuring a policy properly for the infinite banking concept and overfunding into the paid up additions, the majority of your premium, anywhere from 60 to 90%, is going towards those paid up additions. So the commissions the agent is receiving is based off of that 40 to 10% of what's going towards your base premium. So this statement, accurate if that policy is built with 100% base premium. And how you know this as well is if you have an old whole life policy, you'll notice there's $0 of cash in the first few years because most likely it was built for just that death benefit and 100% the base premium.
So your $95 in our example, we would call it $1,200 a year roughly. Your cash value buildup, your savings buildup is zero for 3 years. After 3 years, only after 3 years, do you see it start to build up. Then once it...
Only if the policy does not have the paid up addition premium. Now let me be clear on this too. The design of the policy is very important, but even the insurance company itself is important. When you're implementing the infinite banking concept, you only want to work with mutually owned insurance companies. They're stock held companies and mutually owned companies. We want to work with mutually owned companies. And even if you get to that point of finding that mutually owned company, now you got to make sure that they allow you to have the paid up addition rider on that policy, and they will allow you to tap into the cash value coming from the paid up additions immediately. There's some big mutually owned companies that are great, strong companies, but there's a waiting period of when you can tap into that cash value access.
Once it does start to build up, the second problem is it's a lousy rate of return. Typical whole life insurance policy, all the studies tell us, pays 1.2% average rate of...
I knew we were going to get to the topic of rate of return. If you understand the concept, this is not about rates of return of any kind. This is about controlling the banking function in your life. Your money has to be stored somewhere. And I get this all the time, especially being a real estate investor. Why would I put my money in a guaranteed, boring 4% policy when I could go lend it out to a borrower and they're willing to pay me 12% on my capital? This is not the either or, my friends. This is your and asset. You have to store your money somewhere. And when you're looking to store your cash, what are you looking for? Protection, tax-free growth, accessibility to that money, having freedom to access the cash for what I want, when I want, without having to ask permission to do so. And on top of that, I want it to grow. I don't want to be subject to what the markets or the Fed is out there doing. I want to store my capital in somewhere that's going to grow, guaranteed, no matter what else is going on out there in the world at that time.
Average rate of return. The typical universal life policy pays 3.7%. The typical variable life, because it's invested in mutual funds that should be paying 12 or 14, actually pays about 7%. The rest of it goes to fees.
That's a true statement. When we're talking about UL, IUL, VUL, those sorts of policies, what your IUL agent is neglecting to tell you is there's a renewal cost of insurance every single year. And there's a crap load of fees that they're charging you, and even very, very high cash surrender charges on that policy. Whole life is totally different. Whole life is so black and white. That cost of the insurance is the base premium. Your base premium can never go up and your base premium can never go down. It's set for the life of that contract. And don't neglect the base premium. The base premium just takes a little bit longer to build up the equity and the cash value inside of your policy. But it really starts to go down the road of having a lot more cash value because you have a strong foundation, you have a strong base premium that's there. It's like saying, hey, am I going to build a house on a wobbly foundation? No, I want a strong, sturdy foundation. So that base premium is the foundation, and your paid up edition riders are the structure, the house being built on top of your foundation. And there gets to a point where you're going to have to be forced to drop off those paid up edition riders. And so what keeps carrying on the cash value buildup in your policy is that base premium. Let's continue on.
Now, you have paid at 1.2% and zeros for the first 3 years all this money into this savings account called cash value. And when you die, the cash value that they pay out to you from that savings account is zero. They pay the face amount. So you bought a life insurance policy for $70,000. It should have paid $70,000, and you had a savings account putting $95 a month in it. They should have paid you the death benefit of $70,000, the insurance you bought, plus give you your savings account, right? No,
that's not correct. Dave, you are totally misleading the public here. Cash value is the most misunderstood aspect of whole life insurance ever. And the reason being is because that cash value is nothing more than a prepayment of your death benefit. It is the net present value of your death benefit at that point in time of the contract. So it's like saying, Dave, if my house appraised for $1 million and I have $300,000 of equity inside of my house, am I going to go list my house for $1.3 million, or am I going to list it for the $1 million of what the asset is actually worth? That's what the death benefit is. The death benefit is the true value of that asset. The cash value is the prepayment of the death benefit, and the cash value build up, that equity that you've built up to that certain point in time.
No, you just get the death benefit. So you have a savings account. I'm going to open up a bank today, and Dave's bank, and see if any of you people would ever buy this. Every deposit you make for the first 3 years, zero balance. I keep it all. And then I'm going to pay you 1.2%. And then when you die, I keep your money. Who the crap would save money on that? Nobody. It is the payday lender of the middle class. I've been doing this show for 30 years. Guess who hates me? Whole life insurance salesman. My job is...
Dave, we don't hate you. You're just totally misinforming the masses and the public. See, if you study into families like the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays, and you see how they built wealth and kept the wealth within the family. They're utilizing whole life insurance, because whole life insurance is not just about the death benefit. And we are going to pass away, graduate, die at some point in our life. That's the guaranteed aspect of life. And so the death benefit is just the cherry on top of the cake. And when a whole life policy is structured properly to have access to the cash value immediately, there's so many living benefits of you leveraging this policy to go and buy your cars, buy your houses, pay your taxes, send the kids to college, buy the vacations. And now you're able to spend it, but also save your money at the same time. It's the power of uninterrupted compounding interest. And that's what you neglect to talk about. This is not my either or. This is my and asset. I run the money through the policy first, and then I take it out, and then I go and deploy it to the investment, buying whatever purchase or service that I'm looking at this point in time. That's what we're using with whole life insurance to build tax-free wealth, keep the money in the family, and recycle and recapture every dollar that we're already spending so that we don't have to give the control away to big banks and other financial institutions. Follow along if you want to keep learning more and more about how to truly build your family empire.